The expectations with regards to to cash returns to shareholders, that was projected to be pretty high.
It was projected to be high, and many of the banks already guided that it wouldn't be as high as investors expected. Why is that? Goldman Sachs had been saying they're getting such a good return on equity investing back in the business. JP Morgan guided their investors towards the fact that they preferred acquisitions and growing the business before they gave all that money back. And then, of course, there's the lawmakers' expectation where they want their banks, these banks, to give money back to the communities, to be using the capital to lend, especially in a tough time. Citigroup said the macro environment would be tougher, so that is also something to think about. So when you look at what's happening now, you have Morgan Stanley announcing both a higher dividend, higher than analysts are expecting this year, as well as a buyback program, which is exactly what analysts want to see and investors want to see as the stocks are lower this year. Bank of America, however, they reiterated their current buyback plan and they boosted their dividend, but I will say that that dividend increase is still lower. It's at 22 cents per share, lower than the expectation of Bloomberg's forecast of 24 cents per share. So all in all, that is something to think about. Are these going to be as robust as investors expect?
And Sonali, you said that the banks had sort of guided for this, that the question now becomes, will they be as robust as perhaps investors had been anticipating? I mean, how high are the stakes, given that, again, Wall Street has been sort of preparing the market for this?
The stakes are very high because this is a year where we saw some of the banks actually fall below book value. That's how badly they have been trading, that they're burning value and not really giving investors what they're looking for. Morgan Stanley in particular is an interesting case because during the crisis, they had made two major deals. They have already been using their capital, and now to be buying back shares as well as boosting that dividend when they already had an impressive boost last year, that's an affirmation of the business model. So it's really putting these banks to the test about the decisions they've been making the last couple of years and what these managements are doing, especially in the face of a tougher time ahead.
And you bring up an interesting sort of use of cash theory, not only to hoard cash or to spend it, but how they are spending it. You've talked a lot about the differences between a dividend, which is much more perpetual in theory than a buyback, which feels more like a one-time on an annual or whatnot sort of basis. How do you think about that?
Yeah, and it's a great question because that third arm is acquisition. It is spending to expand, especially in a tough time. Remember, Taylor, there are some things that this year the banks have that they didn't have last year. Last year was a huge talent war. This year we're looking at not that same pace of rapid growth and paying for talent. So they do have a little bit of money in terms of wiggle room here. Trading has still been holding up fairly well. There are other places that are starting to get tougher. So the big global investment banks, they're going to be asked on how they're returning that capital to shareholders, whereas the big commercial banks are going to be asked to be there with clients, including lending clients at a tough time.